I'm Owen Bigland. This is the Inside Edge video blog. Okay, let's go back, or let's do a blog here on the basics of leverage, and I'll touch a little bit on investing, and then I'll finish off with a little bit of the investor mindset versus the speculator and optimist versus pessimist here that I always like to pound home to you guys. Now, you know, in my blog, in my channel here, and I get a lot of comments, and I continually see people just not understanding the tangible benefits that real estate provides, but also the power of leverage. And if you guys know, I'm a big believer in owning and holding real estate for long periods of time, but I'm also a huge believer in buying high quality equities, Canadian and US and international stocks and ETFs. So people get confused though, comparing real estate to stocks. And the big thing that they omit in the value of owning real estate is the leverage component. Leverage is the magic formula. Leverage is how wealth is created. If you were to ask anyone from Warren Buffett to any successful investor, they would tell you that they would never have been able to become a multimillionaire in most cases unless they were able to use some leverage. Leverage, allows you to do fivefold with your money. But you have to be careful with leverage. Leverage can go the wrong way on you. Although, as I've often said, when it comes to leverage in real estate in Canada, it is very difficult, if not impossible, to get into trouble. It is. The Canadian lenders are not cavalier lenders. They're not in the US now either. There was a window, as we all know, back in 2006, 7, and 8 with the subprime stuff, where the US lenders were nuts. They lost their minds and would lend money to anybody and use as much. They would allow you to leverage up to 110, 120% of the purchase price. That would never happen and will never happen in the future ever in Canada. But I just want to give you the basics here because I continue to see people on my comment section here, and to be honest, I just don't have the time sometimes. I'm busy. I kind of refer them a lot of times to buy my book. Pick up my book along for the ride on Amazon. It's going to cost you, $10. I think $6.99 on Kindle. I think now you can buy, there's used books on Amazon now. My book used, you can buy even cheaper. I have an entire chapter in there. I talk about leverage. I have a chapter in there called The Ghost Ship to Wealth. Using leverage, buying a condo, putting a tenant in it, and then just setting it out to sea passively and not having to do anything. Leave it. Let your money work for you. But let's talk about the difference between buying stocks and buying real estate. If someone said to me, I'm going to give you $100,000, $100,000 cash in an envelope, and you could do two things with it. You could buy a condo for $100,000, but you can't borrow the money. You have to pay cash for it. So buy a $100,000 condo and put a tenant in it at, let's call it $600 a month. Pay the property taxes and the maintenance fees and the any repairs and putting tenants in there and having to screen tenants. It's some work. And there's also holding costs, of course, with owning real estate. As I say, repair bills, property taxes, maintenance fees, etc. Or they said that $100,000 you can invest in the stock market. But again, keep in mind, you cannot leverage or use any leverage with the real estate. It would be a no-brainer for me. I would take that $100,000 and I would invest it in the stock market, especially right now. I would buy a basket of stocks. Let's call it, I would buy some Canadian stocks like a Bell Canada. Maybe I would buy a Bank of Commerce. Bank of Commerce right now, or at least a few weeks ago, was yielding 7.2%. That's the dividend on it. Bell Canada was paying me 6.2%. Actually, I think it got up as high as 6.5% in late March. So that is an incredible return or yield. Plus, these stocks, you're not going to hit home runs on the Canadian banks or the telcos. They're kind of what we call orphan and widow stocks. You're not going to get a 30 or 40% spike in the price. But what they will do for you, slow and steady, is maybe get a 2 or 3% annualized rate of return. So on Canadian Imperial Bank of Commerce, you throw in a 7.2% yield, plus add another 2 or 3%. Not every year, but over the next 10 years, let's say, you might average another 2 or 3% in capital gain. Now you're cooking. You're getting a 10% return on that. For every that $100,000 invested is going to pay you, you're going to be making $10,000 a year on that. You'll essentially double your money in about 6.5 years. And the kicker on that, it's completely passive pretty much. You don't have to do a thing. You buy the shares and collect your dividends and watch the stock grow over time. The difference though, of course, that's what I would do if I had $100,000. But of course, in today's world, I don't need to put $100,000 or pay 100% cash for an investment property. You would be crazy to do that. Instead, you want to use some leverage. In other words, you want to put, let's say you buy we'll keep it simple here. You put $100,000, you buy a $100,000 condo, but you're able to put down 10%. You're able to borrow 90. We're just going to keep it simple for argument's sake here. So, in other words, you're putting down $10,000 of your own money, borrowing 90%, to take possession of that $100,000 condo that you're going to put a tenant in. Now, if that condo goes up in the next 18 months from $100,000 to $110,000, a lot of people would look at that and say, hey, you've made a 10% return in the last 18 months. But you haven't. That's the power of leverage. You've actually made a 100% return. Because remember, you've only put $10,000 of your own money in there and borrowed the other 90%. So if the condo goes up 10% in value, which is very likely, you've actually made a 100% return. That is leverage. And so many people kind of forget that. And if you bought my book, I kind of spell it out in there. You know, the other powerful thing with real estate is if you're borrowing that 90%, you're going to pay interest on it. The interest rate now is at 2.1, 2.2%. As a matter of fact, I just saw Royal Bank rolling out a 5-year fixed at 1.99%. You know, you're going to be doing tremendous damage to that principal rate from year one at 1.99%. But the table starts to shift after about 8 or 10 years, where you start to even chip more off the principal and much less towards interest at today's rates. But that's the power of leverage. And people forget that when they compare real estate investing to stock investing. They base it on a cash-on-cash comparison, and you're not doing that with real estate. You know, if you want to buy an investment property, a one-bedroom in Yaletown today for, let's keep it simple, $100,000, you know, you're going to need a conventional mortgage. You're going to put 20% down. So you're only going to need to put $20,000 down to take possession of that $100,000 unit. You know, if the condo goes up $10,000 next year to 110, you've actually made a 50% return if you put 20% down. So keep that in mind. And a lot of people forget that. You know, and it was the other thing too, I had some people asking me, you know, I did that blog about how I had taken some equity out of some clear title properties. And a few people were saying, oh, that's risky, you know, buying it, you know, putting your money into the stock market. Well, it wasn't risky at all, because I was borrowing it just under 2.2%. The interest on it is deductible because that mortgage is on a investment unit, not a principal residence. So the little bit of interest I do have on the money I pulled is tax deductible. I'm borrowing it at 2.2, and I can buy Bell Canada paying me a 6% yield, or Bank of Commerce paying me a 7% yield, plus the capital gain. So there's not much risk there at all. You see what I'm talking about? There's a 5-6% return spread on that. This is how the rich just keep getting richer. Unfortunately, though, it takes money to make money, is what I tell people. You've got to be in this and doing the kind of strategy I've used for 30 years before you're able to start doing those kind of things with your money and leveraging or taking money out of a clear title property. It's that old analogy, you know, the banks will lend you all the money you need, which they will for me, if you don't need it. I sure wish they would have been as generous 20 or 30 years ago when I was starting out, but they never will be. That's why you've got to take slow steps, slow, methodical. And I can tell you, when you get to my age, you know, the gravy train starts. It gets a lot easier. Final thing I'm going to leave you with here. You guys know, if you've been following me on Twitter, I tweet some stuff out here and there. There's a guy, a private equity guy that I follow, that I get he sends me the private equity quarterly letters from these guys. So these are hedge fund private equity guys. These are not available to the public. So I just received one here a couple weeks ago from the guy that runs this. Now, just quickly, I don't want to get sidetracked here. I would love to publish some of these quarterly letters to these high net worth clients that I'm lucky enough to be on the mailing list through one of my associates or a friend of mine in New York. But there is a site called insidermonkey.com. Insidermonkey.com. That site does post a lot of these quarterly letters to their clients from a lot of the big hedge funds, a lot of the private equity guys. You've got stuff on there from Bill Ackman, Buffett, of course. So go check that out. A lot of these things, though, are copywritten, and they keep very close tabs on these letters. Mine that I get sent has strict instructions to not post this in any way to the internet or make public. But this Insider Monkey, I don't know, they post this stuff all the time. But these are fantastic insights from these, billionaire investors in a lot of cases, and what their thoughts are on the stock market and everything else. In his last newsletter, this guy had and he always starts it kind of with some interesting quotes here. And now, as you guys know, if you've been watching the stock market here, we have had an incredible rally here from the bottom. I mean, the S&P 500 is up something like 45% from the late March lows. We had a pullback here as I'm doing this video today of about 2,000 points. And I would expect more turbulence here going forward. But the bottom line is we've had a tremendous rally here from late March. Now, a lot of people, of course, are out there saying this market makes no sense. How can you have a rally like this when the economy is going into a recession and 35 million people unemployed and everything else? Well, the stock market is forward thinking. You have to remember that. The other thing is, of course, is you're not investing in mom and pop operations. I feel sorry for these small independent business owners and restaurateurs and everything else. But, you're investing in these big retailers like Target and Walmart and pharma like Johnson & Johnson and Apple. They have basically become stronger coming out of this COVID thing. So you have to remember that. But here's a quote here I want to read to you guys. And remember, this guy is a very successful private equity guy, been on Wall Street for over 30 years. I don't know what his net worth is. It's probably north of $1 billion. He's a billionaire, this guy. These are the kind of guys you want to pay attention to, who I like to listen to. He says, the first time I heard the phrase, "this market doesn't make any sense," was 1988. I was young and believed it. It took several years before I realized this wasn't analysis, but a personality type. Pretty powerful. So this goes back to what I've talked about many times. You're either an optimist or you're a pessimist. Many people look back on what's happened here with COVID-19 as the world was going to fall apart. Where everything is lost, we're all going to die. Sell your shares, because remember, nobody ever admits to it after you get a rally like we've had. Nobody admits to ever selling back in March. They were always buyers, these guys. Listen, somebody was selling hand over fist. That's why I was able to buy Disney at $83 a share. And I was buying McCormick at $30 less than what it is now. Topping up on Apple at $45 and $50 less than what it was now. I mean, I've got a lot of my US holdings now that are at or near within 5% of 52-week highs again. But somebody was dumping this stuff back in March and early April. So this is, successful people look at these corrections as opportunities. They don't look at them like the world is falling in. And many of these people, they're just baffled by this market. This guy wasn't. Either was a lot of these guys that I follow. They were buying. They saw good long-term value in some of these companies, and that's usually the way it is. Markets usually get oversold. Just like rallies, the recent rally we had was probably overbought, and that's why just recently we're getting another pullback here, which was to be expected. It got a little too jubilant here. Market went up too fast, too quick, and a lot of the stuff isn't baked in on the whole COVID thing. But still, many people here have made a tremendous amount of money buying in late March and early April. I'm not going to sit here and brag. I posted a lot of the stuff I was buying on my Twitter feed, and I've done quite well on it. I'm expecting further pullbacks here throughout the summer and into the fall. We're not out of the woods yet here. But you've got to be an optimist. The people that don't understand the Vancouver real estate market, they haven't understood the Vancouver real estate market for 20 years, these guys calling for the crash. Just look at some of these guys that are doing these blogs and follow some of these. Take a look at the Twitter feed on some of these doom and gloomers. Take a look, go back 4 and 5 years of what some of these guys were saying. It's shocking. You know, Vancouver real estate, it's going to go up and it's going to go down in the short term. The long term, though, have a look at the 30 and 40-year chart on Vancouver real estate. Yeah, there'll be corrections on its path up. But buy your principal residence, hang on to it, enjoy it, get out of that renter treadmill. Take advantage of 1.99% interest rates. Take advantage of the leverage. Take advantage of the principal residence exemption and tune out all these guys that don't understand the market. It's the personality type of these guys, and it is. I feel sorry for a lot of these guys, these doom and gloomers on Vancouver real estate over the years. You can just tell they are angry, bitter, envious. It shows, their tells are all throughout their Twitter feed. They cherry pick all the negative stuff and avoid all the positive stuff. They never talk about anything positive. I paint both sides of the story here on my blog. I'm still under that belief. Real estate in Vancouver is not perfect. You're not going to expect to buy a home today, a condo in Yaletown, and it's going to go in a straight line here for the next 20 years. That's not how it works. It could easily go down 10 or 15% over the next 18 months. But shouldn't be much of a concern to you. You've got a 40-year need there. And I can guarantee after 7, 8 years, you'll have capital gains on that property and you've saved yourself, I don't know, $200,000 in rent, $200K in rent over the next 8 years. It's crazy. But you gotta look at the big picture and the long-term fundamentals. That's how these successful guys on Wall Street look at it. They look at any corrections as can be good buying windows. And they usually are. They're usually oversold, is when you look back on corrections in hindsight. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.